George and Nancy sold a rental property and made a tidy profit. 2 years later, Medicare sent them the bill for it. It arrived as a letter. Their Medicare premiums were going up, not by a few dollars, but sharply. And it hit both of them separately. The strange part? Their income this year was totally normal. Nothing had changed. Whatever this was, it was reaching back in time to punish them for something they'd already done and already spent. Welcome back to Financial Blind Spot. What landed on George and Nancy is called IRMAA, the Income-Related Monthly Adjustment Amount. In plain English, it's a surcharge. If your income is above a certain line, you don't pay the standard Medicare premium for Part B and Part D. You pay extra every single month on top. And it is one of the most avoidable financial ambushes in all of retirement, once you can see how it works. So let me show you the 3 traps inside it. Trap 1, the 2-year look back. Your Medicare premiums this year are not based on this year's income. They're based on the tax return from 2 years ago. For 2026, Social Security looks at your 2024 return. So a one-time spike back in 2024, a home sale, a big capital gain, a large Roth conversion, reaches forward 2 years and lands on your premiums today, long after the money is gone. That's why George and Nancy never saw it coming. In their heads, that sale was ancient history. Trap 2, and this is the cruel one. It's a cliff, not a ramp. IRMAA doesn't phase in gently. The brackets are all or nothing. For 2026, a married couple with income up to $218,000 pays the standard Part B premium, about $203 a month. Go $1 over that line, and you don't pay a little more. You jump to the next tier, where Part B is $284 a month, plus a new Part D surcharge on top. A single dollar of extra income can cost you hundreds of dollars a year. There is no gentle slope. You're either under the line or fully over it. Trap 3, it's charged per person. IRMAA is billed to each Medicare beneficiary individually. George and Nancy are both on Medicare, so when their income crossed the line, they didn't get one surcharge. They each got their own. The household bill was doubled, so here's what actually happened to them. That rental sale pushed their 2024 income to around $240,000 over the first married threshold. In 2026, each of them jumped a tier. Each paid roughly $95 more a month, together about $2,300 for the year, for a profit they had earned and largely spent 2 years earlier. Now here's the part that makes people furious. Usually you cannot appeal this away. There is a Form SSA 44, that lets you ask Social Security to lower IRMAA after a life-changing event. You retired, you lost a pension, your spouse passed away, you got divorced. Those count. But selling a house does not. A Roth conversion does not. Cashing out an investment does not. If your income went up because you chose to realize a gain, IRMAA is simply the price, and the appeal window won't help you. So what actually feeds this monster? Anything that lifts your income in a single year. Required minimum distributions once they begin. Roth conversions. Capital gains, including selling a home or a rental. Big withdrawals from a traditional IRA or 401k. And remember how the income is measured. It's your adjusted gross income plus your tax-exempt interest. Yes, even the tax-free interest from municipal bonds is counted right back in for this. But here's the good news, and it's the whole reason this video exists. Because the look back is exactly 2 years, and the brackets are hard, clear lines, IRMAA is one of the most predictable, most plannable surcharges in the entire tax code. You can see it coming from 2 years away. Before you realize a big gain or run a Roth conversion, you can check where it lands your income against the next threshold and stop just short of the cliff. You can spread a Roth conversion across several years instead of one. You can time the sale of a property. You can manage which accounts you draw from. And if a genuine life-changing event did happen, you file that SSA 44. Here's the reframe, and it's the point. IRMAA isn't really a tax on being wealthy. It's a tax on not looking 2 years ahead. The income already happened. The surcharge is just its echo, arriving late. George and Nancy didn't do anything wrong by selling that property. They just didn't know that one number on one tax return would quietly set their Medicare premiums 2 years into the future. Now you do. And that means, unlike them, you get to plan for it before the letter ever arrives. This is educational information, not financial, tax, or legal advice. IRMAA thresholds and premiums are set each year and change annually, and your situation depends on your full income picture. So confirm the current figures at Medicare.gov and check with a qualified tax advisor before you realize a large gain or convert to a Roth. If this opened your eyes to a corner you couldn't see, you know what to do. I'll see you in